Welcome back. Happiest Minds Technology has been gaining over the last 2 days as the company revised the FY27 growth expectation to 12.5% from 10% earlier. The company says the AI-first strategy and broader portfolio strategic initiatives are generating measurable traction. We have with us Joseph Anantharaju, co-chairman and CEO of Happiest Minds, joining in. Thank you very much for joining in. So, Joseph, let's begin with this guidance raise: 12.5% for FY27, 15% for FY28. What changed in the last 2 months that gives you the confidence to upgrade your outlook now?
Sure. So, Rima, at the beginning of the year, when we announced our 10 transformations, we had also said that these transformations would lay the foundation for 10% growth. And when we announced our AI first strategy in January, we had said that this should lead to accelerated growth and that we will look at, what kind of traction we're getting, and we would get back on what that number would look like. So the last month and a half, what we've done is we've done our revenue plan for the year. We've gone to market with the AI first initiative, started talking to customers. And based on the revenue plan that we put together and the growth in pipeline, and the revenue plan we presented to the board earlier this week. So once we finished presenting to the board and got the approval, is when we made the announcement, because we thought that's the right thing to do, as we had given a commitment that we would get back when we had announced the AI first strategy. So it's based on the revenue plan that we built, the traction we're getting with AI first, and also a few deals that we've closed that were quite large in size and that would contribute to revenues in FY27.
So, Joseph, can you elaborate on this revenue plan, which gets you to 12.5% next year? How much comes from where? For example, AI and even the other initiatives that you're taking, break that down for us, 12.5%. And what's the AI contribution going to look like? What is the pipeline? Is there a number?
So, Rima, on the pipeline, we've not done that. But what we're going to do is, and we're in the process of kind of making sure we have a consistent approach, both for TCV and for order booking. Because we did feel that at a smaller size, that wasn't a very, and the kind of EN that we have, existing business, we didn't think it was a very representative number, but we're going to start announcing that. But in terms of the revenue plan, what we did is we did a grounds up revenue plan where we had each and every BDM and the respective IG heads work on each account. And based on the discussions we've been having with customers, the visibility that we have, we projected out for each of the accounts. We've also looked at last year's, the number of NN logos that we've closed, the kind of revenues that they're giving. We projected that out, and we made some assumptions to arrive at what kind of revenues we'd expect on a quarter-on-quarter basis, based on which we've come up with this 12.5%.
That's the methodology, Joseph, by which you've arrived at the revenue plan. What we wanted to know is the details. How much will AI contribute, for instance? What about the other initiatives?
So if you look at AI, and I'll break it up into 2-3 reasons that really got us to increase this growth, Rima. The first one is, I think, for us, if you look at AI, we have generative AI, and I think, and then I'll take AI and also the other components of AI, that's AI-led, that's your data engineering and all of these things. Now, if you look at generative AI, we will be doing around $5 million purely from generative AI for this year from GBS. Next year, we are targeting close to $12 million from GBS. And if you look at the broader AI only, that is generative AI, AI NLP, and things like that, we are looking at something like 15% of our revenues to come from that. And if you look at AI-led, which would include all data engineering and other things, that should be around 25% of our revenues for next year. So that's one thing that, the component that has gone into this. We've closed a few large deals during the quarter for one of the institutes or management institutes in Southeast Asia. We've closed a $3 million deal. Again, that's AI-led. The core of it is AI, the transformation. For another customer, we've closed, we've won a 3-year, $12 million TCV deal using AI for transforming their support.
Joseph, if I can come in, sorry, we just sort of, good morning, Prashant here. And it's good to see, the market's, of course, happy about it. But just a quick point, right? If I look at the last 5 years, profit growth actually has been absolutely flat. And this is even before all these fears of AI, etc. right? Margins came down from 25% to about 16, 17%. And this is before this new, this all this talk of AI and what this is going to do. And AI generally at the margin perhaps is going to be a little deflationary. Maybe the volume of work will expand. So sales growth is fine over this period. But point is, profit growth has been absolutely flat, stagnant, 5 years now. Joseph, why is that?
So, if you look at the results that we announced, Prashant, our EBITDA is around 20.5, 21%. So again, we have to compare apples to apples. It used to be around 24.5%. And it's come, and we always have maintained that our range for EBITDA is 20 to 22. So we are within the range that we've been committing and targeting right from when we went public. Right now, if you again look at our margins and EBITDA, there are three factors that have come into play. One is we made quite a bit of investment on our generative AI business unit because right off the bat, we allocated 100 people. We put in a solid senior leadership, and some of that is beginning to pay off. And I think over a period of time, it will contribute to our margins. Second is we bifurcated our sales team into NN and EEN, account managers, client partners. So that was a huge cost or investment. I would call it investment for last year of close to $3 million because we hired a totally fresh set of people.
All these initiatives, Joseph, are over the last couple of years, right? Last year or so.
Yeah, last couple of year and a half, 1 year to 2 years.
What I'm saying is, for 5 years, profit growth has been actually the CAGR has been about minus 4-5%.
No, Prashant. If you go back and look at the our EBITDA percentage till 2.5 years back when we started GBS, it was in the 23 to 24% range, and that's come down only over the last 2.5 years. And as far as Gen AI being deflationary, again, it depends on how you price it, right? If you're looking at fixed price and if you factor in your productivity increase from Gen AI, what we've been doing is that we've been splitting the benefit that comes from productivity increase, and where it's more of extended engineering or T&M, it's based on rates, so there is really no deflation. In fact, if you look at GBS and our analytics COE, their rates are much higher than what we command for the rest of the services. GBS would be around 20-25% more, and analytics and AI would be around 10% more from a rate realization standpoint.
Okay.
So do you get back to the 22-24% margin band? You're currently at 22%.
I think, we would, if we get there, I think that'll be good, Rima, but we would be comfortable with 20 to 22% as long as, we are investing for growth and making sure that
at least till the Vision 2031, where you get to $1 billion of revenue, your plan, the business plan is the margins stay between 20 to 22%. They don't expand.
Yes. Oh, so we are looking at the $1 billion based on the 12.5, 15% aspirational growth that we project for 28, looking at the market. So we're trying to see, will it be 2031 or would it get delivered by 2031? Market conditions were a little different, but we're hoping that, we can get there. But we will, the goal is to get to $1 billion, Rima.
But it might get delayed on account of the current situation right now, the markets. That's what you're trying to signal.
We need to work those numbers out. Yeah.
Thank you. Thank you very much, Joseph, for
Thank you very much. Bye-bye.
Thank you. Dipan Mehta